Hi, I'm investing is common sense. I'm going to discuss with you about Malakoff Corporation Berhad, an overvalued company based on my valuation methodologies. However, my valuation is not a buy or sell call. Please do your homework while buying a company. Malakoff has two major segments, namely power generation and waste management and environmental services. Malakoff foreign power generation segment that has an effective power generation capacity of 588 megawatts and water desalination capacity of 472,000 cubic meters per day with the businesses in Saudi Arabia, Bahrain, and Oman. It is the largest independent power producer in Malaysia with an effective generating capacity of 5,822 megawatts, and this segment is the biggest contributor to the company in terms of profit and loss. In 2021 and 2022, revenue of domestic thermal power generation accounted for 85% and 90% of total revenue respectively. Therefore, the performance of Malakoff is highly affected by the fuel prices. The fuel cost accounted for 66% of total cost of sales in a 6-year period from 2017 to 2022. The fuel mix is coal, gas, and oil. Based on the effective capacity by each power plant, Tanjung Bin Power and Tanjung Bin Energy power plants, which use coal as a source of power generation, accounted for almost 50% of total effective generating capacity. We can assume that coal is the main source for electricity generation. According to a power purchase agreement, Malakoff needs to keep at least 1 month of coal inventory. The purchase price is called weighted average coal price, which is the coal price that Malakoff purchased from TNB field, while applicable coal price is used to calculate energy payment to Malakoff, which is set on a monthly basis by Energy Commission since August 2022. Malakoff usually purchases coal 3 months in advance and set the selling price 1.5 months before the delivery of electricity. Therefore, when the global coal prices are increasing, Malakoff is the beneficiary and vice versa. Let me demonstrate this using a hypothetical example. Assuming the coal price in June is 1 ringgit, Malakoff purchased it. In the mid of July, the coal price increased to 2 ringgit and Malakoff makes an agreement to sell the electricity for the September based on the coal price of 2 ringgit. Therefore, Malakoff earns 1 ringgit from the price gap. I am assuming applicable coal price as a proxy for weighted average coal price because I could not get the data. From 2021 to 2022, the applicable coal price jumped from 464 ringgit per ton to 1,073 ringgit per ton. The local power generation revenue and net income increased from 5.5 billion ringgit to 9.3 billion ringgit and 250 million ringgit to 844 million ringgit respectively. However, for the 9 months period ended 2023, the average applicable coal price decreased to 832 ringgit per ton. The revenue and net loss decreased to 6 billion ringgit and 366 million ringgit from 6.6 billion ringgit and 567 million ringgit in the corresponding period. I was just showing you a very simplistic example for the illustration purpose because the time period that I used was a 1-year period gap and applicable coal price as a proxy for weighted average coal price. In fact, the company has 2 months of inventories. The price gap is 2 months instead of 1 year. Secondly, Malakoff is using the weighted average coal price for the purchase price, but the information is not available. So I use applicable coal price as a proxy. Malakoff started to venture into the sector of waste management and environmental services by acquiring a 97.37% stake in Alam Forah in December 2019 from the RB Highcom for 869 million ringgit at a price-earning ratio of 8.98, price-to-book ratio of 3.14. It is the biggest environmental services company, providing the services of solid waste collection and public cleansing in Kuala Lumpur, Putrajaya, and Pahang, and waste recovery and treatment like generating electricity and fertilizers using food waste, discovering recyclable materials from municipal solid waste. It is managing 5,748 tons of waste per day, accounting for 15% of 38,000 tons of waste per day produced by Malaysia. It aims to achieve a recycling rate of 15% to 20% by 2025. That is enough to fill up the whole Petronas Twin Towers with the capacity of 315,000 tons a year. In addition to that, on the 27th of October 2023, Malakoff entered into a share sale and purchase agreement for the proposed acquisition of a 49% stake in Dividend, which provides project management, consultancy, and contracting services in the field of solid waste management. Dividend has the same service with Alam Forah, like solid waste collection and public cleansing, but in different areas like Kedah and Paris, with the concession agreement expiring in September 2023. On the 15th of March 2017, Malakoff issued a perpetual sukuk with the nominal value of 800 million ringgit. It is a semi-annual perpetual bond with the first call date on the 15th of March 2024, which means the company can redeem the bond on the 15th of March 2024. The period distribution rate is 5.9% from the year 1 to the year 7. It will be increasing 1% a year starting from year 8 or the 15th of March 2024. For example, the company is paying the distribution of 47.2 million ringgit per annum from 2017 to 2023. In 2024, the company needs to pay 55.2 million ringgit and 63.2 million ringgit in 2025. It is shown under shareholder equity and treated as equity financing because there is no obligation to repay the principal of 800 million ringgit, but only the coupon payment, which is likened as dividend. However, I beg to differ. Malakoff is obliged to pay coupon. I will be treating Malakoff perpetual sukuk as a debt instead of equity. Reason being is dividend payment is not an obligation, but distribution of perpetual sukuk is an obligation. The company may choose to pay or not to pay dividend to the shareholders every year. If the company is losing money this year, it may choose not to pay dividend. However, if the company is losing money this year, the company is still obliged to pay coupons for perpetual bonds. We can calculate the net present value of a debt by discounting the future cash flow of the coupons. I am using Tanjung Bin Energy Islamic medium-term notes average yield of 5.5% as the discount rate for Malakoff perpetual bond. If the company calls the bond on the first call date, which is on the 15th of March 2024, the net present value of the perpetual sukuk will be 809 million ringgit. However, if the company chooses not to call the sukuk forever, the net present value of the perpetual sukuk will be 3.66 billion ringgit. Therefore, we can presume that the company will call the bond in one day. Therefore, it must be treated as a debt instead of equity in this case. From 2017 to 2022, Malakoff made an average 290 million ringgit per annum, but it still had high accumulated losses of 358 million ringgit in 2022. The reasons are the company paying high dividends to shareholders and profit distribution to perpetual sukuk holder. The company dividend payout ratio was more than 100% over the 6-year period, averaging 111%. The source for the payments of dividends were most likely from cash brought forward of debt financing, because it just makes the total of 245 million ringgit free cash flow to equity compared to 1.712 billion ringgit dividends issued to owners of the company over the 6-year period. For the 9 months period ended 2023, the accumulated losses increased drastically to 1 billion ringgit, partly due to negative fuel margin, as I mentioned before. This is a highly levered company, as the debt to equity ratio was around 3 in the third quarter of 2023. Therefore, the high debt is a reason behind low free cash flow to equity. Since I'm treating perpetual sukuk as a debt, I include the distribution as a form of interest payment. The company repaid an average of 771 million ringgit interest on borrowings and 1.073 billion ringgit principals on borrowings a year, and total of 4.63 billion ringgit interest repayment and 6.439 billion ringgit principal repayments over the 6-year period. Therefore, even though the company was making 1.85 billion ringgit positive cash flow from operation and 160 million ringgit cash flows from investing a year, the company was still ended up a small amount of 40.87 million ringgit free cash flow to equity holders. Also, this company earning quality is bad, as shown from an average of 5.11% return on equity. On top of that, average return on assets stood at 4% over the 6-year period. Return on assets is an unlevered return, or the return before any debt financing. Returns on equity is a level return after debt financing. As we can see from these two metrics, return on assets and return on equity show that the return on investment for the projects invested by Malakoff are a single digit. Over the long term, the returns of the projects will be affecting the performance of the company, which will directly affect the return of the ordinary shareholders. To value this company, I'm using both discounted cash flow and dividend discount model. Firstly, I'm using discount rate of 10% for the cost of equity for 4 reasons. First, the earning quality is bad, as shown by return on equity and return on assets. Second, due to ESG issue, the company needs to transform itself as the key priority, which is uncertain and take time. Third, the company produce a small amount of free cash flow to equity holders. Fourth, Malakoff is subject to commodity pricing risk like coal price. As I mentioned before, this company produce an average free cash flow to equity holders, which is 40 million ringgit a year or 0.0084 ringgit per share. I am using 40 million ringgit as free cash flow to equity and discount rate of 10% and no growth due to highly volatile financial performance over the years for my discounted cash flow model. Therefore, the valuation of operating assets will be 400 million ringgit or 0.084 ringgit per share. If we were to use dividend discount model, due to Malakoff, dividend payout ratio has been more than 100% from 2017 to 2022. The valuation of this company is 0.506 ringgit. However, the dividend is not likely sustainable owing to small amount of free cash flow to equity holders over the years. Therefore, the dividend might be reduced or the company needs to borrow more debt for dividend purpose. Therefore, dividend discount model is not the best model to value this company. In my dividend discount model, I'm assuming no growth due to highly volatile financial performance of Malakoff. I'm using the average 6-year earning per share at 0.0506 ringgit as my dividend and 10% discount rate in the dividend discount model. Therefore, the valuation of this company is 0.506 ringgit using dividend discount model. If anyone is interested in learning stock analysis, please contact me by my email. My email address is in the description. I passed CFA program in 2 years and achieved a distinction for my master degree in finance, investment, and risk from University of Kent. I am also building financial models for companies. If any company is interested, please contact me by my email.